Okay, on the cash flow, this is something that we're going to have to work through the homework and discussion. It's very difficult to take a whole statement of cash flows and work through it on a video. So I'll just give you the overview here, a couple things to think about, and help you out in the discussion forum as we go forward. This will be a topic that we'll look at here briefly in the principles course, and then you'll see it again in intermediate accounting and get into cash flow a little bit more. By the end of that course, you should be pretty familiar with how to take financial statements and all the data and do a cash flow from scratch. So what does the format of the cash flow statement look like? Here is just a crude little outline that I've done. This is just like the income statement, something that is over a period of time. So you would see for year ended 12/31/2010 would be an example of a heading there for the cash flow statement. So we got three different sections: operating, investing, and financing. And transactions are going to fall into one of these three categories. The bulk of transactions are going to go in operating. These are the transactions that normally occur in the operations of our business. So when we buy and sell product, when we pay our employees, these type of things are going to fall under our operating section. The investing section are going to do with long-term assets. So think about your land and buildings and investments, all these different things that are long-term assets that we're buying and holding for a profit later on. The financing section is related to your debt and your stock. So as we go out and we borrow or we issue stock, or as we pay back stock, or we purchase treasury shares, these are transactions that are going to go in the financing section. So the easiest part is to look at investing and financing. And these are basically just the pluses and minuses. Let's erase these X's here, because those were just meant to correspond to the subtotals. So we'll have the pluses and minuses in each of these sections as we see money coming in from investing activities and money coming in and going out from the financing section. So let's look at this real quick. What would be a plus from an investing section? Well, if we sold some investments that we previously had, we would see cash coming in. So we would have a title that said cash from investments. That would be a positive coming in. What about a negative? Well, if we bought something, that would qualify as an investing asset. So purchase of a building, we got money coming out, so that would be money that we would subtract from that section. You're going to see this, say the first one was 100 and the second one was 50. If it's money going out, if it's a use of cash, we'll just show that in brackets there. Okay, what about financing section? What would be an example of a plus coming in? Well, what if the most common one for a corporation is going to be issuing stock. So if we issued $1,000 of stock, we have investors paying into the company, we have $1,000 coming in. Okay, what about a use of cash? Well, what if we pay back some bonds that we had? So that might be $700 there. We paid back, so that would be a use of cash there. So, in these two simple examples here, we would just sum these up. That would be a net of 50 coming in and a net of 300 coming in. And we would just have a subtotal here that would say net cash from investing activities, net cash from financing activities. So we looked at the investing and financing. That is not going to change regardless of the method that we do. Now, there is going to be a difference between the operating section, and we looked at we have two different methods that we're going to talk about: the direct method and the indirect. Okay, and now there's a chart on page 506 that looks at the direct and indirect method. First, let's talk about the direct. This is going to be kind of the most easiest one to conceptualize here. Just like we did on the investing and financing section where we had the actual inflows and outflows, that's what the direct method shows. So here we would have like cash from sales, and we would show that in the actual amount. Say we had 1,000 cash coming in from sales. We might have cash paid for rent. Okay, so we might have a use of cash going out like that. Okay, now this kind of corresponds to the cash basis of accounting that we talked about earlier. Remember, that's not GAAP whenever we don't accrue for things that run over our current accounting period. But this basically says when cash comes in, this is recorded under the direct method. So usually there's some adjustments that we have to make to determine these amounts. Let's look at just one quick example from cash from sales. We won't do an example of every different type, but we have to run this through our account receivable. Okay, and we'll ignore any allowance account just for the time being to make it simpler. So we'll get to that $1,000 here in just a moment. Okay, so we might have a beginning account receivable balance of $500. Okay, and we know our ending balance is $300, and we were given sales of $1,200. Okay, actually, let's do it this way. Sales of, sorry, I can't add here. Yeah, sales of $800. Okay, so as we would look at this to determine what is the cash received from sales, well, what amount is this? Well, we're looking for the amount that goes in this box over here. What is the credit taken to AR? Remember, our entry here, cash from sales, would be debit cash, credit account receivable. So we need to know how much account receivable is credited for the cash there. Well, so what happens here when we do this transaction for sales, assuming these are all in account? We debit account receivable and we credit sales. So we know that this $800 here must have been debited to account receivable and credited to sales. So we basically say 500 plus 800 is 1,300. The ending balance is 300. So what goes in this box? 1,000 there. That's the amount that must have been cashed from sales. So under the direct method, this isn't going to just be given for you usually. Usually you're going to have the income statement amount, and you're going to have to run it through one or two balance sheet accounts like this account receivable here. You have to do the same thing for like cash paid for inventory and cash paid to employees for wages, those type of things. So that's just a quick example of the direct method. We're looking for the actual cash that changes hands here.